let's reel back in.
Yes, please.
So thank you for being here and participating in this homebuyer webinar brought to you by the Path2Sold Real Estate team. My name is Robert Masoudpour, realtor and associate broker with Atlanta Communities. My colleague, Brian Borders, mortgage consultant with Tri-Stone Financial, is also here with us to answer any home loan questions you may have. I believe now more than ever in this ultra competitive real estate market, it is so important to know how to navigate your home buying process and win in a multiple offer situation. In this webinar, you'll learn what it takes to buy a home, how to obtain a loan, and make the right moves to get the best deal. I have a deal right now where I just put the house in the market today and this morning, and I have 7 offers on it already. So, and the seller and I are going crazy trying to navigate through the offers and pick the best ones. So, you know, it's crazy. It's crazy now. Why are we here? To learn how to navigate the home buying process, to identify the steps necessary to achieve our goal of home ownership. We will cover in this webinar the steps to home ownership, what steps to avoid, how to get started, 4 parts of a home buying process, how to obtain a loan, and different types of loans. And Brian will be able to help us out with that. My question right now for you is, can you name some of the benefits of home ownership?
Yeah, I think it probably helps build wealth for the family, right?
That's right. So builds wealth. You build equity or ownership in your home 2 ways: through appreciation, when your home goes up in value over time, and by paying down your loan balance through monthly mortgage payments. You can also, the benefit of home ownership is tax savings. Mortgage interest and property taxes are deductible. This means you don't have to pay income taxes on the amount of your earnings that you use to pay mortgage interest and property taxes. For example, if you're renting, not only are you not getting the equity, you also don't get the tax write-off for the mortgage interest. The homeowner or the landlord does. Another way is pride of ownership. You can make improvements to your living space and benefit from the increased value to the property. Security, as long as you make your payments, you can't be evicted or have your rent raised. Build good credit. A good credit rating is important for many reasons. One of the best ways to build a strong credit history is through on-time monthly mortgage payments. So there's many ways that you benefit from owning a home instead of renting. Can you name some of the responsibilities of homeownership?
You got to pay the bills.
That's right. On-time mortgage payments. That's right. Late or missed mortgage payments can result in high late fees, damage to your credit rating, and in the worst case scenario, foreclosure, loss of your home to the lender. Be sure you're prepared to make full on-time payments. Build up an emergency savings fund to cover your mortgage payment in an emergency like job loss or illness or etc. You also have to be responsible for property taxes and insurance, which are most often paid through an escrow account. However, these are required expenses as a homeowner. Repairs and maintenance. As a homeowner, you don't have a landlord to call when the water heater breaks or when your gas oven breaks down. You will have to pay for all repairs out of your own pocket. You will also want to maintain your home, keep up landscaping, clean the gutters, paint, re-roof, things like that, so that it retains its value and you avoid bigger or more expensive problems that result from allowing a home to get run down. You have to purchase your own appliances and equipment. There are also expenses. These are also expenses you have to account for, especially if the appliances are older. Also, if you live in a neighborhood with HOA covenants, you will have to maintain your property to meet their standards and requirements. You know, with homeownership comes some responsibility. Third question, What are some of the costs of buying a home?
Condo fees, loan
Loan
fees.
fees, credit report fees, appraisal fees, earnest money deposit, down payment, and closing costs. These are the costs that you have to consider when you're going to shop for a loan and buy your home. Home purchase costs such as PITI, principal, interest, taxes, and insurance. The components of your monthly mortgage payment. Taxes and insurance are part of the escrow account, like I mentioned earlier. Mortgage insurance, also known as private mortgage insurance or PMI. This monthly addition to your mortgage payment is required if you make a down payment of less than 20%. The insurance protects the lender in case you default, fail to make payments on the loan. Moving expenses. This includes everything from the moving truck to required repairs and necessary appliances. Emergency reserve funds. You may or may not be required to show the lender you have a cash reserve, but it's a good idea to have one anyway, so you won't have to pull out the credit card to cover every unplanned expense. So assessing your financial resources for your down payment and for your monthly payments. Down payment sources, savings, private gifts, retirement account loan, second piggy bank loan, VA loan, or private and government down payment assistance programs. Are you financially prepared for homeownership? Determine next steps to reach your goal. Do you have any questions so far with what I've covered?
I guess, Robert, and maybe we can talk about this a little bit later, but I think sort of it might be useful to sort of dig a little bit deeper into sort of like those home purchase costs, closing costs. I had sort of someone ask me recently about this very topic, and I think maybe this is also a sort of something that Brian could sort of chime in on. And I think sort of as agents, it's important for us to be able to really solidify what it's going to cost. I mean, sure. Brian, a couple of weeks ago, I had a client that bought a place. As he was handing me over the P&S check or as we were signing the purchase and sale agreement, he said, I don't know if I'm going to have enough cash for the closing costs. And I'm just like, oh man. So, I think that Robert, as sort of just, for me and you to sort of realize that this is something that often gets overlooked, and it's something that we should really kind of like
Absolutely.
dial in on and make sure that that's sort of an important point that we make sure that people don't overlook.
That's why
Robert,
I'm sorry to cut you off. That's why it's so important to get hooked up with the right lender that will explain all that stuff to you before you begin your home search, right? To make sure that you, as a home buyer, you have all your ducks in a row, have enough money for down payment, enough money for closing costs and all that before you begin to begin your home search. That's why I recommend to everybody that whether they're first-time home buyers or seasoned home buyers, the first thing you do after you talk to your realtor is to get hooked up with the right lender that will sit down with you and explain to you what is involved in buying a home and how to get your, as I said, get your ducks in a row and not be blindsided later on by, oh my gosh, I don't think I have enough money for down payment or for closing costs or whatever. I'm going to use today's example, today's deal as an example. It's such a competitive market now that the sellers are asking the buyers to make modifications to their offers left and right if they want to win the bid. And if you're prepared to get your loan, you are able to make those modifications and win the bid and get the home that you want. Otherwise, the next guy who puts a bid in is gonna win the offer.
Yep. Hey, Robert, I was going to say, if you wanted to go back to that home purchase cost, I'll just run through that real quick. Just to The one that has the loan fees, the
There was
next, the one
there
report.
was another page, Robert. I think the one. Yeah,
That
there
one.
we go. Yeah.
Okay.
So, loan fees are going to be standard pretty much for everybody. They're, the attorney fees that go in there, which is part of your closing cost. You've got title for the lender and both for the purchaser. I mean, those are all standard ones. You've got taxes you got to pay. Government's got to get their hand in everything. Some lenders do charge an application fee. We do not at TriStone. That's just money in their pocket. And frankly, we don't operate that way. Some fees we do pass on exactly what we get paid. Credit report fee would be one of those. A verification of employment is one that we would pass on as well. Appraisal fee, we've actually run into a good problem, which is if you're putting 20% down, there's a good chance you can get an appraisal waiver, which means you can save $470. You don't have to pay for the appraisal. It's accepted as that value. Earnest money actually comes out of your down payment. And then the down payment is determined by which loan program you're going to choose. And so we'll go over those in a little bit, between FHA and VA and all that kind of stuff. But I will say that typically for most lenders, not ourselves included, most lenders are going to charge between 2.5% and 3% for closing costs and prepaids together. Typically, ours is right at 2.5 or less. So 2.5 would be the high side for us. So that's where our competitive advantage is.
And that's an industry norm, Brian. I never heard that about sort of a percentage cost vis-a-vis the overall sale price of the property.
Mm-hmm. Yeah. And so ours, like the closing costs are typically about 1.5%, 1.6%, somewhere in that neighborhood. And then you add on your prepaid, which typically is about 1% or so added on. So that's where we come up with the 2.5% for us. If you're adding points into your loan, obviously that's going to increase it. So if you add a point to the loan, you're looking at 3.5% as opposed to 2.5%.
Right.
Okay.
Yeah, that's very helpful. And I think that, I think, Robert, just to reiterate, I think it's part of our responsibility to make sure that our clients have a full snapshot of what the expenses are going to be. And, to your point, Robert, I think it's excellent. That's a good excuse to bring in your mortgage partner, to bring in your attorney partner as part of our team, right? These are our teammates that say, hey, look, let me bring my partner, Brian, in here, and we'll go over all of the expenses that you can reasonably expect are going to be tacked on to the sale price of the home.
Absolutely.
Well, my thing is I don't want the client to spend any money on earnest money or anything like that, or a home inspection if they're not going to qualify. Because if they're not going to qualify, they don't have the money probably to pay for those things up front. And it's better for them to not waste their money and everybody's time if they don't qualify.
I like it.
So let's move on to the FICO score. You may have heard of this term, FICO score. A high FICO score not only improves the chances of a loan approval, it influences the interest rate on the loan. A higher FICO score results in a lower interest rate. So we encourage you to find out your FICO score before shopping for a loan, so that you can find out where you stand and take measures to improve your FICO score if necessary. And of course, your lender will be able to do that for you too. And they usually do that when they run your credit report and get you pre-approved for a loan. Let's see what's. So FICO is a numerical snapshot of the information in your credit report used by most mortgage lenders to assess your credit worthiness. Scale ranges from 300 to 850. However, lenders want to see a score of at least 640. Obviously, the higher the FICO score, the better rate you get on your loan. So make sure that you check your credit report and pay off any debt you have that will always raise your FICO score exponentially, especially if you have no debt on your no outstanding debt on your FICO, on your credit report.
Hey, Brian, can I ask you a question?
Yeah, absolutely.
Thinking about credit scores, Robert, and I don't hear a lot of my colleagues talking about this as an offering. But what if my credit, needs some work? What if I'm looking for a loan, but my credit isn't great and I want to take a year to try to improve it? What do I do in that scenario to try to get my credit better? And maybe it takes longer than 12 months. But do you guys have sort of a program or a company that you work with to try to help people get their credit up?
So it obviously depends on the situation. So what's going on with credit? If it's a really bad situation, we will refer to credit counseling. We'll give them some names of some counseling agencies they can contact to try and help them out. If it's something I think that just needs some time and that they can handle it on their own, I will recommend some ideas for them. Typically, it's lowering the balances on their credit cards or their credit lines of credit. So if we're anywhere between 30 and 60% on the balance, we're good. That the credit companies love to see those numbers. Anytime you're over 60% utilization for your credit, that will actually drag your score down a little bit. If we've got derogatory items like collections, it really is determined by, so if you're just going to pay them off, like I had a client that I talked to today that wants to pay them off with her tax return. Well, that's going to probably take 6 months to a year for that to really change for her benefit, because it's going to show that she had a whole bunch of late payments. So we need the late payments to go off. We need to show it paid. If it was something that was an error and it's taken off immediately, their score will go up immediately. So that's talking to each individual client about that is it's a whole different animal. But those are just kind of some general ideas of what we do.
And I'm thinking, Robert, as we are kind of like, we're all encompassing in our sort of advisor role. And I think this is something that we should have in our toolbox to say, hey, look, we may not all be working with, A+++
Right.
clients. And we should, specifically to what Brian was saying, have that path to help our clients get to a better place if they're not in sort of ideal credit situation. So I think this is a great sort of point to bring up, Robert, and to sort of moving forward, make that a part of our, offerings, really.
Absolutely. You're absolutely right.
I will add one more thing in there too. We've got a tool. So when we run our credit, it comes up and it'll show their scores, and then it'll say how we can improve their scores. So I can look at improving it immediately. I can look at improving it over the next 3 months. And so I can change the scenario. We can say, okay, this one has a lower balance. This one's paid off. And we can see how that's going to affect things in 3 or 6 months or whatever that time frame is. And so we can advise the client and say, these are some things you can do to potentially get your score to this number. And that's, I have done that.
That's a really good idea, Brian. You think about that. All of our clients aren't necessarily thinking spring 2021 to buy. Maybe they're fall 2021, maybe they're spring 2022. So we can, Robert, have paths for different levels of our clients. And maybe those clients that need 12 or 18 months for credit are on that 18-month plan and work with Brian and his folks to improve that.
Absolutely. That's why Brian's here.
All right.
He's the man. That was a great discussion, guys. Nice job. So let's go to the how to improve your FICO score, as we were talking. If you have a good payment record, keep it up. If you don't, you can improve your score by starting now to pay all your bills on time. Unsatisfied old debts count against your score. Pay off debt rather than simply transferring balance to new cards. Avoid taking on new credit unless you are trying to establish credit. Maxing out your credit cards using 100% of the available credit looks bad to lenders and lowers your FICO score. Keep your balance as low as possible compared to the credit limit. Since your FICO score is based on the information in your credit report an error in your credit report could lower your score. Check your reports and correct any errors per instructions provided with your reports before you apply for a loan. And in Georgia, we can get a free credit report every year. I make it a point to get my credit report on my birthday, just so I won't forget. And for information on that, you can contact me or contact Brian, and he'll be able to help you out. Where can you get a loan? There's so many places you can get a loan from. You can get it from mortgage company, from commercial bank, from credit union, from a mortgage broker, other financial institutions, federal government loan programs, and housing finance agencies. But take it from me, it is so key to go to a reliable lender to get your loan from. And your realtor has that reliable lender that they work with, like I work with Brian, who they trust and they know that can get the job done, especially in this market where things move so fast. In seller's market, if things don't move fast, you're going to lose out on deal. So it's very important, like Pete said, to have that arsenal in your quiver with a lender and a closing attorney that can help you get you to your home buying goal.
I'm going to add one thing to you on there.
Sure.
I'm going to toot the mortgage broker horn a little bit. I work with 10 different banks, and I go from non-prime loans to every kind of loan you can think of that a banker would do. With that comes multiple different products with each bank that I work with. If you are going to a commercial bank, they're giving you their product only. Mm-hmm. So that product may not be the best fit for you. So whereas I can look at your situation and say, okay, we might need to go over here to this bank because they have a better program and better rates for you. And then another client may be better at a different bank. So that's one of the advantages of a mortgage broker, as opposed to some of the other ones that are on here.
So Brian, you're not going to like this. Okay. So maybe close your ears. Okay? But I often suggest to my clients to talk to a number of different mortgage brokers. I would agree. With the idea of having the possibility of getting a better rate. I just think that that's good, due diligence. Would you agree with that policy?
I absolutely would say to get at least another quote from somebody else. I'm more than happy to walk through that with the client. And if that other person's better, I'll say that person's better. I can't beat that. Or if I'm better, I'm going to say, here's where I'm better. Typically where I get ahead of most people is I don't have an application fee. So that's $400 or $500. It's back in the client's pocket. I mean, think about it. It's a new washer or a new dryer for them.
And that appraisal fee too, you can waive if they're putting down a certain amount. Correct. I mean, that's real money. That adds up.
It does.
Yep.
Absolutely. There are different loan types. Fixed rate mortgage, which is very popular now. It's 30 years, 15 years, 20 years. Interest rate stays the same for the life of the loan. Or an adjustable rate mortgage, which is also called an ARM. Interest rate adjusts periodically, so monthly payment is subject to change. Typically offers a low starting rate for a specific period. This one is not as popular right now because the mortgage rates are so low right now. So fixed rate is something that most buyers will go with and most lenders will recommend.
And I was going to say, typically those ARMs are in 3, 5, 7-year terms.
That's right.
Most popular being 5 and 7.
Yep, absolutely.
Brian,
they have a balloon payment, right, Brian?
There is a balloon payment at the end, yes.
Exactly. Go ahead. I'm sorry, Pete.
Brian, what's the most popular type of loan you're working with today?
Today is going to be a conventional 30-year, just because the rates are so low. People are just looking to lower their monthly payments. So even on a refinance, that's the route they're going to go. We do have a number of clients that are going to 15-year. Once COVID hit, the ARMs got pulled back, and they did not do them for a while. I have yet to see any of the banks offering them again. Not that they won't here sometime soon, but once the rates start to go back up, I have a feeling they're going to come back. But But really, FHA, we have not done a whole lot of FHA in the last year. So it's been conventional Fannie Mae or Freddie Mac loans.
Why do you think that is?
Typically, FHA has a smaller margin for their debt to income ratio. And so with COVID, that's just kind of hit that market. The people that are usually those borrowers have just been hit harder by that. And typically, if we can get somebody into a conventional, that's the route we're going to go, because over the long term, that's usually the best route for somebody if they're going to be in the home long term, especially at a 2 3/4 interest rate for 30 years or something.
Right.
That's the way to go.
And FHA, obviously, FHA and VA, because they're government-backed loans, they have restrictions,
Yes.
especially the type of home you can buy, or and also VA doesn't have any mortgage insurance, but FHA definitely has the mortgage insurance payment that you have to deal with for the life of the loan. So those are restrictions that you have to abide by when you go with the other loans. So comparing loan features, interest rate, fixed rate loan, initial interest rate of ARM, rate adjustment period and rate caps of ARM, repayment period, loan term, prepayment penalty, fees and APR, lock-in options and fees, approval process schedule.
And I'm going to jump in just to say, this is something that most buyers do not know. There are 26 different items that go into somebody's interest rate.
Wow.
So when you see on TV that, hey, we're offering this rate, there's 26 different items that go into it. And it's the amount of the loan, your LTV, which we'll get to in a little bit. There's so much, what kind of property it is, how you're paid. Those are all things that determine your interest rate. So.
Excellent. 26. That's crazy.
I had no idea. I had no idea.
Yeah, neither did I. How much of a mortgage can you afford qualify for? It depends on the down payment amount you have, the loan to value ratio, and the debt to income ratio, and the housing cost to income ratio. Next, you have the loan to value ratio, which lender is willing to lend up to 90% of the property value. The property appraises for $200,000. You receive an approval for a loan of $180,000. That's basically how it works. $200,000 times 90% is $180,000. Lenders have policies about how much a property's value they are willing to lend. It could be 80%, 85%, 90%, or even 100%. To figure out the maximum loan a borrower can qualify for based on the loan to value ratio, the lender hires an appraiser to determine the market value of the property. The lender then takes the value and multiplies it by the percentage it is willing to lend. As I said, for example, if a lender is willing to lend up to 90% of a property's value and the home you want to buy appraises for $200,000, the lender would be willing to lend up to $180,000 on that particular property. Debt to income ratio, mortgage in this case includes PITI, the principal, interest, tax, and insurance, plus PMI and homeowners association condo dues if applicable. These ratios are only guidelines. There are also numerous programs designed to help low-income consumers and those with weak credit obtain an affordable mortgage. Some of these programs don't apply a maximum housing to income ratio, and they allow a higher debt to income ratio.
Right? Yeah, and that's where I'll jump. Yeah, that's where I'm gonna jump in and tell you. So like a VA and an FHA are going to be 50% is your debt to income ratio.
Right.
That's their limit. Most conventional loans are going to be at 46% debt to income ratio.
Okay.
Those are very good tidbits to know, sort of have handy for sure.
Absolutely. So these two terms are so widely used right now whenever you want to buy a house, whether you get pre-qualified or pre-approved. What's the difference? A prequalification is an estimate of how much of a loan you might qualify for. It's not a firm commitment. Pre-approval is a firm commitment from a lender for a specific loan amount. The approval can be valid for as little as 30 days or as much as 120 days or more. Nowadays, in this competitive market, with sellers market, most sellers are asking for pre-approval letters to be given out with your offer. They want to make sure that as a buyer, you can afford their house and you're not just kicking the tires or get out of the purchase if you don't qualify, if you don't end up to getting the loan.
And for me, on the pre-approval, that's pretty much all I send out is pre-approval. I don't even do a pre-qualification.
Right.
Pre-qualification to me is just talking to the client.
Right.
So pre-approval, I have pulled your credit. If it's necessary, I will run it through the automated underwriting system prior to to make sure everything looks good and we're qualified. But I always pull credit before I do a pre-approval.
Excellent.
So Brian, if I'm going to be applying for a loan through you guys, and I go through this pre-approval process, is that going to ding my credit score? Is that going to nick me on the number? How does that work?
So anytime you pull credit, it is a bit of a ding. But the mortgage pull looks different than, say, a credit card or a car payment, because they know that you're planning something the underwriting is much more stringent than the other ones. So they look at that a little bit differently than, somebody's going out and get 3 credit cards in the last 3 months or whatever. You can have multiple pulls on your credit for mortgage in a month, 3 or so. It will affect your score. Is it going to affect it 5 or 10 points? Maybe. So if you're near the 640, you want to pull your credit one time, and I would still say, try and get your credit score up. But I would also talk to somebody else as well. But knowing that they already have your credit, I may just say, here's what the credit is from this client, even though they will have to pull it at some point, just to give it a little bit of space. But typically talking with a client like that, I mean, we do pull their credit. Now, also for somebody that was at 640 or something, that is an instance where I would probably run it through the automated system before I even issue the letter.
And that's a scenario where, if they're going to be right up against that 640, we got other issues to worry about.
Yes.
Here. And
typically, yes.
And I guess sort of something, Robert, for us is to suggest that, and there's no sort of polite way to do this, but to suggest that our clients have a sense of what their credit score is.
Absolutely.
Before sort of diving into this. And I think that 640 number is a good way. And we can just generally say that, people with credit scores closer to 640 might have a little bit more of a challenge, and leave it at that. And, you and I, Robert, don't care about their credit score. That's Brian's job.
Absolutely. And that part of discussion is part of my buyer presentation, that when I meet a buyer, is I make sure that I ask the question, hey, what do you think your credit score is? And it's interesting because most buyers know what it is. With sites like Credit Karma or all these different sites that give you your credit score now, most buyers are pretty astute, and they know what's going on with their credit and where they stand. So that's a good thing. Well, that's a great idea, Pete. So why use a real estate agent? This is my wheelhouse right here. Why do you want to use a real estate agent to buy a home? Well, or to do a real estate transaction? Well, a real estate agent is your confidant. And you know that on the other side of the table, the seller has someone that represents them and watches out for their interests. So you want to make sure you have someone on your side that does the same. Also, real estate agents have access to the MLS. They have market knowledge. They usually with the areas you're looking at. They have guidance through buying process. So they give you what to do. They kind of guide you through how to approach putting in an offer and what you need to do to win that offer. They handle the paperwork. There's a lot of paperwork that goes around when you're putting an offer on a house, when you want to buy a house, and it could get overwhelming. So the real estate agent's job is to get rid of that overwhelming feeling off of you and handle all that for you. And also your real estate agent has an incentive to make you succeed, because they earn their commission when you buy the house. So it's a good idea to have a realtor on your side. And also I want to add that in most areas like Georgia, when you have a buyer's agent, in most instances you don't pay a commission for your buyer's agent. The seller pays a commission. So it's basically getting a advisor for free. So it's a good idea to do so.
But that will contradict, Robert, when we talk about our buyer agency agreement and that we require a 2.5% or 3%, on the buy side. So just as something to think about, where that it's free to the buyers may not be true all the time.
True. Yeah, there are always different circumstances, but yeah, in most cases, it's a complimentary service. So when you make an offer, how do you make an offer? You get the property address, you get the offer price, you talk about the earnest money, the good faith money deposit, how much you want to put down. So the offer price is it could be the same as the asking price, or higher or lower than the asking price, depending on the situation. The earnest money deposit is a deposit that tells the seller that you are serious about buying their house. It's usually about 1% to 2% of the asking price. You will have to write a check for this amount at the time of you make the offer. The money should be deposited with a third party or put in escrow, most likely, and then the money goes towards your purchase when the deal goes through. Down payment, you disclose how much a down payment you will make. I usually discuss this with your lender. Financing terms, stating loan amount, loan type, maximum interest rate, and maximum points protects you in case you can't get the loan you want. In other words, you can get out of the deal if the only loan you can get is an adjustable rate mortgage when you want a fixed rate mortgage, or if the interest rate and points you must pay are far above what you planned on. Closing costs clearly states which fees and settlements or closing costs are being paid by the seller and which are being paid by the buyer. And then the closing date and possession date, that's to make sure you allow enough time between the offer and the closing to conduct all inspections, get the appraisal done, and have the loan funded. The closing date and possession date are not necessarily the same. You need to spell out exactly what date the seller must vacate the property. And then this one is important, expiration of offer. You want to make sure that you put down how long you're willing to give the seller to consider your offer. This may be just a couple of days, or if the seller is out of town, you may want to allow for more time. Nowadays, in today's market, the expiration date is usually 12 or 24 hours because it's such a competitive market. And then the contingencies, these are all the conditions that must be satisfied by a certain date for the transaction to continue. If any one of your contingencies is not satisfied, you may be able to walk away from the deal without penalty. Common contingencies include financing, loan funding contingency, home appraisal, and home inspection. And they're usually time periods for all those, for the home appraisal and for financing contingencies. Normal right now in our market is around 15 to 21 days. And then home inspection is usually done in a certain amount of time called due diligence period, where it's usually about 5 to 10 days that the seller will allow you to do all the inspections you need to do to the house and still be able to terminate your offer, your contract, and get your earnest money back. This is not true in everywhere in the country, but in Georgia, the due diligence period allows you to do that and get out of the contract without any penalties. Negotiations. After considering your offer, the seller may accept, reject, or modify. It's called the ARM method. So you always have the chance to talk to the seller and maybe counter offer or and make modifications, especially in this market. Or the seller may just say, you know, I'm done with this. I want to try again with somebody else. Or they may accept the offer, which is the best case scenario. What to expect from the lender. So the lender will send you a loan estimate, typically within 3 days of a completed loan application. And then within 3 days of loan estimate is within 3 days of application, discloses all loan costs, states, interest rates, and points, lists closing and other fees, helps you compare loans, and make sure that you understand this is only an estimate.
Yeah, I'm going to jump in here too. So we are required, once we have a completed loan application, that means contract, everything, the application's at 100% filled out. We have all of the information from the borrower. We have 3 days to send you the loan estimate, the borrower the loan estimate. That, as it says, is an estimate of all of the fees that are associated with the loan. It is standard across everybody, that every banker or mortgage broker, they all look the same. So you can compare them side by side very easily. Mm-hmm. I also, in the initial process, when I'm talking to the client, I send what's called a fees worksheet that is an easier read than the loan estimate of all of the costs associated with the loan. So they can see exactly where it is. Loan estimate just puts them in a couple different places. But because it's standard, everybody can see where they are and compare them side by side. So I think that was the only thing I needed to add on to that.
Excellent. Thank you.
Mm-hmm.
Closing and settlement, 1 or 2 days before closing, I usually take my buyers to the house and do a final walkthrough, which gives you the opportunity to make sure the property is in the same condition as when you made the offer. The visit will normally be arranged by and done with me, your real estate agent, if you have, obviously if you have one. And also the walkthrough will also go through if you have asked the seller to make any repairs or anything to the house that the home inspector suggested. The walkthrough, you make sure that the seller has done that before you close on the house. On the day of closing, you attend the closing. You also make sure that you examine the closing disclosure, which you will receive at least 3 days prior to closing, and then you wire any funds to the closing attorney. And then on the day of closing, you attend the closing, you review, sign all documents, and write a check for any outstanding costs. In Georgia, we do the closing at a closing attorney's office. For a buyer, the closing usually takes about an hour and 15 minutes. So make sure you allow enough time to do that. So successful home ownership. To be a successful homeowner, you avoid risky loans. Borrowers should think twice about taking out a loan that starts out with a low payment or low rate, but can make an extreme jump later on. Also, loans that allow negative amortization, where your payments are so low that they don't even cover all the interest due each month. So you actually end up owing more money over time than you originally borrowed. So this, Brian, would this be considered like a LIBOR loan?
Oh, you're talking about like the ARMs, the 3, 5, and 7-year ARMs?
Or
they
the ones
could be.
Or the ones that start out just with interest only loan, and then they balloon up to a.
Yep. Yeah. So the ARMs are going to be the same way. So they're going to be, 3, 5, or 7. It's either 3 years or 5 years or 7 years that you pay interest only, and that's tied to the LIBOR. And so when that jumps, it's typically capped at a certain amount that it can only rise a certain number of times and a certain percentage above what you start out as. But so you could have a severe increase in your interest rate and your payment's going to jump severely if that's the case.
Absolutely. So if you're unsure about the type of loan you're considering, speak to your lender, or attorney or a housing counselor. Borrowing against equity, home buyers should be careful about taking out a home equity loan or home equity line of credit, particularly if they plan to use the money to pay off credit card or debt or go on vacation. If they are not able to make the payments on their home equity loan, a debt, which is a debt secured by their home, they could lose their home to foreclosure. On the other hand, if they miss payments on a credit card and unsecured debt, their home would not be at risk. So get help. Point out in the get help from a certified HUD housing counselor to make sure that you're taking the right steps. So, question: do you have any questions about this home buying presentation? Anything? Anyone?
No, it's been great so far.
It has. Well, unfortunately, we've come to an end. So thank you for your time and for attending this webinar. I really appreciate you. We look forward to helping you find and buy your new home. If you have any questions, please do not hesitate to reach out to me. My information is here, or reach out to Brian Borders about any mortgage or loan questions. I appreciate you. Thank you, Pete, for participating and checking us out. I appreciate you, brother. Stay warm in Boston. I heard you guys got a lot of snow.
We did get a lot of snow the other day, and we got some more coming, I think, on Friday. But it's February. It's Boston. It's New England. I mean, what do you want?
That's awesome, man.
That's what happens.
I love Boston. It's one of my favorite cities. Brian, thank you so much for your knowledge and for your expertise and for chiming in and sending us straight. I appreciate you.
Absolutely, Robert. I enjoy doing it. You are great to work with, and I would highly recommend you to anybody that's looking to buy.
Hey, thank Brian, you. I have a very close friend of mine that is an agent in Atlanta, and I'm gonna sort of make an introduction to him from you. And I just did a screenshot of your email address, so I'll touch base with you. So you have my contact information. Then I'll set up an email introduction, because I think if he's newer to the business, I think he's probably in his second year. So he probably still needs to meet some good people in the business, and you would be a good guy for him to get to know.
I can testify for Brian. He's very thorough, he's very knowledgeable, and he will take your hand and walk you through the process and make sure that you're making the right decisions when you're buying a home, and you won't get sidetracked or blindsided by any surprises. So definitely he's a good guy to have in your corner.
I appreciate that, because we had the client this summer, I won't say who it is, but there was a self-employed borrower that I had to work with for the month prior to her purchasing to get her in the right spot. So the fact that we were able to work together for that first month or so, got her set up so that when she went through that process, it was very easy.
And I remember you telling me that you're a 1099 guru, so so I'll remember that again. Hey guys, you guys are awesome. Thank you so much. This was really fun, and hopefully we'll try to do this again and get it going.
Hey, this was the first one, Robert. It gets easier from here. This was a great first effort. So well done.
I appreciate it.
I would agree. Great job.
All right, guys, take care.
See you. Bye-bye.
Thank you.